Let's talk about something that often gets overlooked in the world of business finance, the statement of owner's equity. Now, I know what you might be thinking. Sounds boring, right? But stay with me because this document is a goldmine of information about your business's financial health, and it's crucial for making informed decisions about your future. So, what exactly is a statement of owner's equity? In simple terms, it's a financial statement that summarizes the changes in ownership equity over a specific period of time. Think of it as a report card for your business's ownership structure. It lays out the contributions made by owners, the distributions they've taken, and any other changes that have impacted the owner's equity balance. In essence, it tells you how much of the business you actually own after all debts are paid off. Now, why is this important? Well, owner's equity is like the lifeblood of your business. It represents your stake in the company and gives you a clear picture of its financial health. If you're a business owner, understanding this statement is crucial because it helps you see how well your business is performing and whether you're on track to meet your financial goals. It's your chance to take a step back and evaluate whether your business is thriving or if it's time to make some changes. Let's break it down a bit further. The statement of owner's equity is sometimes called the statement of shareholders' equity or the statement of partners' equity, depending on your business structure. It includes several key components: starting equity, owner contributions, profits or losses, withdrawals, and ending equity. Starting equity is the amount of capital you had at the beginning of the period. Then you have owner contributions, which are any additional investments made into the business. Next up is the net income or loss for the period. This is where you see how well your business did financially. Did you make money or did you take a hit? And finally, we have withdrawals, which are the amounts taken out of the business for personal use. When you put all of this together, you calculate your ending equity, which is the amount of capital you have at the end of the period. But here's the kicker: many people mistakenly believe that the statement of owner's equity only reflects owner investments. That's just not true. It includes all ownership changes, such as profits, losses, and retained earnings. It's also important to note that this statement is not the same as a balance sheet. While a balance sheet gives you a snapshot of your financial position at a specific moment, the statement of owner's equity shows you how your equity has changed over time. Now, let's talk about why you should care about this statement. For starters, it provides transparency and credibility. Keeping accurate records and having a clear statement of owner's equity shows stakeholders that you're serious about your business. It builds trust with investors, customers, and even your employees. Additionally, the statement helps you identify trends and changes in your business's financial health. If you notice that your equity is consistently declining, it's a red flag that something might be off, and it gives you a chance to address potential issues before they escalate. And speaking of trends, this statement is invaluable for making informed decisions. If you see that your business is consistently generating profits, you might decide to reinvest in new equipment or expand your operations. Conversely, if you're losing money, it might be time to reevaluate your strategy or cut back on expenses. Another key point is that the statement of owner's equity is often required for legal compliance. Many countries mandate that businesses prepare financial statements, including this one. If you fail to do so, you could face legal consequences. For those of you seeking financing, this statement is often a crucial part of the package. Lenders and investors want to see that you have a solid understanding of your business's financial health before they commit any funds. Now, let's get practical. How do you actually write a statement of owner's equity? It's not as daunting as it sounds. Start by determining the period you're reporting on. This could be a fiscal year or a quarter. Next, list your opening balance, add any income earned, deduct any losses, include owner contributions, and subtract withdrawals. Finally, calculate your ending balance. Present it clearly, and voila, you have your statement of owner's equity. Different types of businesses use this statement. Sole proprietorships, partnerships, corporations, and even nonprofit organizations all benefit from keeping track of their equity. It's a universal tool that can help any business owner understand their financial standing. And let's not forget about the potential red flags that can arise from this statement. Unusual increases in owner's equity, inaccuracies in capital contribution, or unauthorized distributions can all indicate financial irregularities or even fraud. So, keeping an eye on this statement can protect you from potential pitfalls. In conclusion, the statement of owner's equity is far from boring. It's a vital tool that provides insight into your business's financial health, helps you make informed decisions, ensures legal compliance, and builds credibility with stakeholders. Whether you're a seasoned entrepreneur or just starting out, understanding this statement can empower you to take control of your business's future. So, the next time you sit down to review your finances, don't overlook this important document. It might just hold the key to your business's success.